Assalamualaikum warahmatullahi wabarakatuh. I'm Frisca Novia, Master Student in Management at State University of Jakarta, and will present my research proposal entitled Fundamental and Non-Fundamental Factor Determining Hedging Decisions, Evident from the Miscellaneous Industry Companies in ASEAN 2016 until 2021 period. The background to this research is based on phenomenon. The growth of international markets motivates companies to develop their business through international trade. The most significant risk of international trade transactions is foreign exchange rates, which will have an impact on cash flow. The development of international trade in Indonesia shows good performance as demonstrated by the total export value in 2016 until 2021, which exceeds the total import value in 2016 to 2021. Cumulatively, Indonesia has an import value of up to 990 million US dollar and exports worth 1.5 billion US dollar. Indonesia has 23% of international trade value originating from countries that are a member of ASEAN. ASEAN has key elements in its efforts to realize a highly integrated and cohesive economy, one of which is trade in goods. Intra-ASEAN trade in goods increased 1.3 times from USD 277 million in 2016 to USD 370 million in 2021. Singapore, Malaysia, and Thailand are the main destinations for international trade, with miscellaneous industrial sectors having the large trade value. The risk of exchange rate fluctuation faced by companies due to international trade will have an impact on the company's cash flow. Hedging can be used by companies as a tool to minimize exchange rate risk. The Minister of Finance Regulation Number 36 PMK 8 2017 concerning hedging transactions, Article 1, Number 1, states that what is meant by hedging is a method used to mitigate risk or protect the value positions of an underlying assets or liability due to price fluctuation in the market financial, which includes future interest rates and currency value. Hedging is determined by several fundamental and non-fundamental factors. Fundamental factors are considered to be related to risk because risk can be determined by the company's fundamental value. Meanwhile, non-fundamental factors are related to economic conditions such as exchange rates. The results of several previous studies shows that a non-fundamental factor that can influence hedging decision is the exchange rate by Sophia and Yunelin. Meanwhile, fundamental factors that can influence hedging decisions include liquidity, profitability, leverage, firm size, and managerial ownership. Several previous studies relate to the relationship between fundamental and non-fundamental variables on hedging policies can be seen in the following research gap table. The problem formulation for the research is do exchange rate, liquidity, profitability, leverage, firm size, and managerial ownership affect hedging policies in miscellaneous industrial companies in ASEAN for the 2016 up to 2021 period. Then the research objective to the research is to determine the effect of exchange rates, liquidity, profitability, leverage, firm size, and managerial ownership on hedging policy in miscellaneous industrial companies in ASEAN for the 2016 up to 2021 period. Then the research benefit of this research as a reference, especially related to hedging policy factors, and become a reference for making hedging strategies so the company can achieve the desired profit. Then literature review. The grand theory used in this research is risk management. Companies are always faced with various risks that can affect organizational performance, such as business risk, strategic risk, and financial risk. Risk management is a set of policy and procedure to manage, monitor, and control the risk faced by a company. One of the risks that a company faces when carrying out international transaction is exchange rate fluctuation. In managing this risk, company need to implement risk management. Exchange rate fluctuation requires strategies including providing a certain amount of reserve funds to support the risk themselves or transferring risk to third parties with derivative instrument. Next is corporate finance theory. Corporate finance theory refers to a set concept and models used to understand corporate finance. There are four main theoretical groups in corporate finance theory, such as investment theory, dividend policy theory, capital structure theory, and acquisition and merger theory by Sen. This is based on Santi et al. 2022. Then corporate finance theory analyzes the relationship of company fundamental variables to hedging. Then we have some variable. Furthermore, hedging is the first one is hedging. Hedging is covering loss in the initial assets position with profit from the position of the hedging instrument. According to PSAK number 55, the criteria that can be used to determine whether a company uses hedging is by examining the implementation of risk management strategies for hedging, identifying a hedging instrument, and identifying transactions or balance that want to be protected. The exchange rate is determined by the intersections of the market demand curve and the market supply curve. Exchange rate fluctuation encourages companies that have foreign currency denominated transaction to hedge. Then measurement to find out how liquid a company is used. The liquidity ratio, the existence of short-term liability dominate in foreign currency makes the company decide to hedge. Then the profitability is a measure obtained by a company in a certain period to determine the profit obtained. High profitability also motivates company to expand business activities to international market. Then leverage is a ratio that calculates the extent to which company assets are financed with company debt. High leverage denominated in foreign currency means the company will face a higher risk of default. Then firm size is the total value of assets, equity, and company sales. Large company will carry out stricter risk management, such as implementing hedging policy. The last one is managerial ownership, is the amount of share ownership owned by company management. Managers will tend to minimize risks that cause loss and decrease company value. Next is the research hypothesis. The first one, the effect of exchange rate on hedging policy is positive, which hypothesis one, the exchange rate affect hedging policy. Then second one, the effect of liquidity with hedging policies is negative. With hypothesis two, liquidity affect hedging policy. Then the effect of profitability with hedging policies is positive. With hypothesis three, profitability affect hedging policy. Then the effect of leverage with hedging policy is positive. With hypothesis four, the leverage affect hedging policy. Then the effect of firm size on hedging policy is positive. With hypothesis five, firm size affect hedging policy. And the last one is the effect of managerial ownership with hedging policy is positive. With hypothesis six, managerial ownership affect hedging policy. The following is the research frameworks: exchange rate, liquidity, profitability, leverage, firm size, and managerial ownership are independent variables, and hedging policy is the dependent variable. Then research method using secondary data sources. company in miscellaneous industrial sectors list on the Indonesia, Singapore, Malaysia, Thailand Stock Exchange in the 2016 up to 2021 period. This research sampling technique used purposive sampling, namely selecting samples by considering certain criteria. The sample to be used in this research must meet the following criteria, such the company has annual financial report that have been audited for 5 consecutive years from 2016 up to 2021. And then the second one, the company has emerging foreign exchange exposure, and the last ones, the company has financial report in Indonesia or English. The data collection technique in this research is documentation. Documentation is carried out by recording or documenting secondary data list on the website of each exchange. Then literature research or library research was carried out by studying various reference books and relevant previous research. Next, the operational definition is an operational explanation of the variable that will be used in this research. The dependent variable used in this research is the company hedging policy. The hedging assessment is calculated using a dummy. The dummy is used to quantify qualitative variables. Company that have hedging policy will be given the code number 1, and if the company does not have hedging policy, it will be given code number 0. The independent variable in this research is the first one, the exchange rate used in this research is change in the US dollar exchange rate against to Indonesia rupiah to the dollar in 1 month, with middle rate is selling rate minus buying rate divided into 2. Then the liquidity, the current ratio, is obtained to find out whether current asset can be used to pay short-term liability. The current ratio can be formulated as follows. A current ratio is current assets divided into current liabilities, and then profitability will reflect the company's ability to manage its asset to generate profits after tax. The profitability ratio in this research use return on asset or ROA. Return on asset can be formulated as follows. Return on asset is earning after tax divided with total assets. Then leverage, total debt to asset ratio is used to find out how many assets are funded using debt or how much influence debt has in managing company asset. The debt asset ratio calculation can be formulated as follows. Debt to asset ratio is total debt divided with total assets. Then firm size can be determined by assessing the amount of asset owned by the company. The assessment of the size of the company assets will be converted into natural logarithm form. The firm size calculation can be formulated as follows. Firm size is ln or natural logarithm with total asset. Then managerial ownership is the percentage of shares owned by manager. The calculation of managerial ownership can be formulated as follows. Managerial ownership is share owned by manager divided with total share outstanding times 100%. Then analysis of the data used in this research. The first one is descriptive statistics are used to describe or depict data by looking at the maximum, minimum, average, and standard deviation value. The second one is logistic regression is used to test the ability of the independent variable to predict the possibility of the dependent variable occurring. Stage of logistic regression testing according to Ghazali 2018 using the following analysis. First one, test the overall suitability as overall model fit test. The hypothesis model fits the data if -2 log L is 0, more -2 log L is 1. Then coefficient of determinant test, modification of the Cox and Snell coefficients Nagel curse R square was carried out. Then the third one is regression model feasibility test. Hosmer and Lemsau goodness of fit test is used to the test to know feasibility of the regression model. And then classification determinant test. The model is said to be perfect when on the diagonal there are all cases with forecasting accuracy level of 100%. Then the last one is logistic regression test. Hypothesis testing using logistic regression can be done by estimating parameter. That is the presentation of my research proposal. Thank you for the time given. Wassalamualaikum warahmatullahi wabarakatuh.